Assuming you're going to retire tomorrow, what should you do with your cash pile that is saved up over these years of work? Today I'll be sharing with you this method called retirement buckets. And in this method, it should hopefully answer, should you buy bonds, should you buy equities, how should you deploy them so that you can get your money beating inflation, as well as to have sufficient enough for your day-to-day expenses during your retirement years. So if you're curious to find out and you want to get yourself ready, continue watching on. Hi guys, welcome back. Without further ado, let me explore with you this retirement bucket method that was first developed by wealth manager Harold Evensky in 1985. The strategy began as a simple now versus later approach whereby you segregate this retirement savings pool that you have into something you need to consume now as in 0 to 5 years later, and then subsequently 5 years and above in your entire retirement period. This whole approach really gives you the clarity how you should deploy the money. This 0 to 5 years first bucket, let's call it cash bucket. This one, you put it in very safe assets. Fixed deposits, bank account, get interest with it, will do. Expense out from this bucket for the next 5 years. Then bucket B, this is called the equity allocation bucket, where you invest it. Get it to compound at a rate of return that is higher than inflation. I think this 5-year theory has a lot of logic. Because if you look in terms of equity markets, S&P 500, you will realize that markets go up and down, correct? So every 5 years, you can kind of survive even a down period. If you look back in terms of history, this period was about 5 years and the next one is also about 5 years. This time around, S&P 500 has been bearish for 1 year plus. It seems to be on the uptick, but even if it isn't, I think a 5-year window definitely gives you the best chance to ride out this entire wave. Then what about for Singapore Index? You will realize that I've drawn over here some brown swings, correct? Every 5-year period, you can kind of make it to a positive ground already, even though there's some crisis that happens within that window itself. This is proof that markets go in cycles. And when there's a down cycle, the best thing that you could do quite possibly is just to hold it. But thinking back, as a retiree, no active income source, it's quite scary to ride through market downturns. When we are still working in 30s, 20s, there's still a long time horizon. So that fear, we cannot quite appreciate. But when I speak to older retiree clients, I do realize that preserving wealth is very important to them. In practice, it's not so easy to just not cut off losses when you see bad performance in the equity portfolio. So with that, I'd like to throw a quick first suggestion on what to do, especially for this equity allocation bucket. My suggestion is to be broad-based. Don't pick individual stocks. Lean more towards funds and ETFs that are diversified because recovery, as I've shown you, is more than a certainty. If we see individual stocks, let's use 3 of Singapore's blue chips. First is Keppel Corp, second is DBS, and third is Singtel. I put them up to show you a world of difference. DBS is that golden line over there, correct? It has doubled in the last 15 years. But what we can see is that Singtel has done next to nothing over the last 15 years. Share price went up, but right now it's back to a price where it's 15 years ago. Keppel Corp, on the other hand, has declined over the last 15 years. In a 5-year window, you would realize that it's not too easy to pick stocks that actually did not decline, even though these 3 names are all blue chip. So the second suggestion on how you can understand not to cut losses wrongly during bad market periods is to educate yourself properly about market volatility. Not market noise, market volatility. Study not news, because many retirees have time, they flip open newspaper, they read news on the phone, and they start to hear noise such as, China is going to attack Taiwan very soon. But if you spend time to study history instead and be very familiar that markets have even survived World War II before, you will realize that there's always a lot of negative news and they may not correlate to what's going to happen in stock market in the foreseeable months ahead. The third way to help yourself practice proper investments and not cut losses wrongly when you are retiree having equity portfolio is to think about the worst case situation first. Listen to your gut feeling in terms of your risk appetite. What has been your investment journey along these years? Because take note, if you have $1 million, in this bucket situation, if your expenses are $50,000 a year, that means only $250,000 is going to the first cash bucket and $750,000 is invested into the equity bucket. When the portfolio is large, a 30% drop would naturally mean a $250,000 paper loss in your second bucket. Think very carefully whether you're comfortable with it. because again, there's no best number that you should put towards each bucket. The reason why I presented this first is because currently, cash buckets are able to produce an interest rate that's significantly better than many times in the past 10 years. Right now, cash, fixed deposits, Singapore savings bond, T-bills are all producing 3% or even slightly more than that. But think about a future whereby interest rates go back down again. This cash bucket, if it gives you only 0.5%, it's not going to work too well again, correct? That's why let's evolve this to something more encompassing, which is this risk-based approach of retirement buckets. In this situation, 3 buckets are created instead of just 2, which is cash and equity. Right now, there's a cash bucket that is for a 3-year horizon only, your expenses for next 3 years, and a defensive allocation bucket. Finally, the equity bucket is on the far right. The defensive bucket should be for expenses after the first 3 years, which means you should have a 3 to 7 year time horizon in this defensive bucket. And what instruments can be invested with this? They should include short-term bonds, endowment plans possibly, and high-yield bonds. So it should be things that can give you about 3% even if interest rates go back down. Then the equity bucket again is there, and its focus again is to bring in equity funds or stocks. And in this bucket, it's quite natural to expect 6 to 10% in terms of performance, which means to grow it above inflation rate. Now in this concept, what you want is to spend the first cash bucket, correct? And then assets in the second bucket will be sold down to replenish the first bucket, which is cash, when it's used up. And conversely, the third bucket, equity, is sold down to move assets into the defensive allocation second bucket. Over time, money is used from the first bucket and slowly flows from the third to second and second to first. And if we project what's left at the end of your life, it's quite possibly left with the first and second bucket only. But wait, you'll be thinking of this question. Then isn't it directly transferring from bucket 3, which is equity allocation, to bucket 1 if every time we use bucket 1, we fill it up with bucket 2 and then bucket 3 flows down also? The answer is actually no, because there's a timing issue. Theoretically, if equity markets are doing well and there's a profit in bucket 3, yes, some money can straight be pulled off from bucket 3 to be used instead of using bucket 1, which is the cash holdings. Conversely, if equity markets are bad, that's why you want to just consume bucket 1 and not touch bucket 3 first until it recovers. So this sidesteps, in theory, the sequence of consumption risks. When equity markets are down, you don't want to consume from there. You have kind of a cash buffer, and on top of that, you even have a defensive buffer. So if it makes sense to hear already, smash the like button, and as always, leave your questions in the comment sections below. Let's move on to the next question that we have. 50,000 annual expenses, I'll put 150,000 in first bucket. Then what should I do with bucket 2 and 3? How much should I put exactly into them? Now, some suggest to use your risk appetite. If you are balanced risk, then use 50-50. 50% into defensive allocation bucket, 50% into the equity allocation bucket. Some feel that you should put maybe 4 years into the defensive allocation bucket and the rest into equity. And that could become quite aggressive, especially if your cash savings is quite big. While it's good also because the equity allocation bucket should grow the fastest, that may also cause sleepless nights if you are not properly prepared, not properly educated. And that's why I mentioned in the previous point, to really educate yourself about market cycles and be very zen about negative market news. Then what about for someone that's very conservative? Should they put more, 70% to defensive allocation and then just 30% to equity allocation bucket? Quite clearly, there's no one size fits all. There are a few cons to highlight, however. The first is that it's good to dissect what we should put into different time horizons. But again, for our financial freedom figure, that whole study also with a 60-40 equity bond allocated portfolio for a portfolio to be tested to survive 25 years of yearly expense drawdown. It's not factored in when we think about this bucket strategy. Then the second problem again is how to decide which to drain, correct? Now this problem should be highlighted because back in 2022, bonds dropped and equities dropped. It's very different from in 2008 whereby bonds rallied while equities dropped. Which means also both the defensive bucket and the equity buckets were both down. So it's hard to decide which to drain from. The third problem is that shouldn't we buy equities when equities drop? That is a good time to invest, correct? And is there a way to do so? Because in this method, we're just filling up. There's no way to capitalize on Mr. Market when he is giving you good deals on the equity front. That's why doing this research, my own personal conclusions are that investment time horizon is less important than asset allocation. Personally to me, I've seen many instances where investors think that they have a 7-10 year time horizon, and when equity markets are down everything is thrown out window. Everything becomes too conservative. And when equity markets are high, that's where there's a bit of greed coming in, expecting a strong rate of return above what is inflation rate. That's why this is my suggestion and a simpler way again to look at things. Back to the 2-bucket strategy. I'm suggesting this template of 3 years of expenses just in cash, whereby you park into fixed D or Singapore savings bonds. Let's think back on a world where interest rates are low again. We don't want to have too much cash. So whatever left after 3 years should be invested in a mixed 60-40 bucket, same as the way the study for financial freedom was actually done. This negates against the defensive allocation for 3 to 7 years horizon, and then the equity allocation, which is 7 years time horizon. I think again, time horizon is less important than asset allocation, which means in this 60-40, we stick to asset allocation of 60% equities, 40% in bonds. When equities go up, automatically the fund sells and rebalances to buy more bonds. And when equities go down, that converse is done. Bonds are actually used to buy equities. I think auto rebalancing is very important, and it will, in my opinion, deliver the necessary results to give you an outcome that's not too volatile, that's 100% equities, and then also an automatic method to sell away equities when it's on a high. So coming to here, I have actually 2 suggestions to start things rolling. The first is SIFE Core Growth Portfolio. This over here is 68.4% in equities, 25.8% in bonds, and 5.8% in commodities. I think this is something that's unique, and you can see the breakdown in terms of ETFs of its holdings. This portfolio is global and slightly more in equities. So if you're new to SIFE, you can actually check out my links below. Referral code ASTUTEParent. For a fee waiver, terms and conditions apply. This is the backtested result. Make sure, as always, it fits your risk appetite. Make sure you invest an amount that is comfortable with you. The next suggestion is a fund that has been on the market for a very long period of time, and I've seen many of my fellow advisors use it to build clients' retirement portfolios. This is the First Sentier Bridge Fund that was first set up in July 2003. You would realize over here that since inception, the performance is 6.1% annualized. This is the 10-year performance of this fund. You realize that at some periods, it was doing very good single-digit returns of 6 to 8%. But for the last 3 years, things hasn't been too good because it has allocations again in China, Hong Kong, and Taiwan. Which brings back our story. If we put 3 years in the cash bucket, someone who is invested in 2001 will be quite close to drawing down everything from the cash bucket already, because the discipline is to not touch this one when it's down unless the cash bucket is dried up already. And the cash bucket is drying up quite fast, unfortunately. But I do believe that over the long horizon, this still has a better chance of beating inflation than holding everything in cash. This is just a 3-year bad period. The saying always goes, after good periods, there are bad periods. After bad periods, it's good periods again. So it's actually fine to stick to the plan. Thank you for watching to here. As always, smash a like, smash a subscribe, because this is the first part to this whole retirement bucket series. In the next episode, I'll be expanding the topic of retirement buckets against expenses. Everything we talked so far is either time horizon or asset allocation. How much do you exactly need to park inside to each of these buckets to make sure you have enough first? There's something to answer in the next discussion. So as always, stay tuned for it, and thank you again for watching to the very end. And with that, I'd like to invite you to one of my previous tutorial where I touch on the top 8 funds that you can invest for lifetime. If you haven't seen it, check that out. I think it has some surprising names inside also. If that's all from me, and see you there too. Take care as always. Goodbye.